We got through the first levers of monetary policy. Let's talk about essentially the only lever of monetary policy that's used, or at least the one that's most prominently used, the one that the Fed leans the most heavily upon, and that is open market operations, which sounds like a really big, complex thing. But remember, economists use jargon to make us sound smarter than we actually are. So this is nothing more than the Federal Reserve going into bond markets and buying or selling bonds. Bond markets, I mean, there are exchanges where bonds are bought and sold, and what the Fed will do is it'll go and it'll offer prices. It'll maybe bid for bonds, saying, "Hey, I will pay this higher rate for bonds than everybody else is paying." Or if it's looking to sell bonds, it will offer bonds that are worth a certain amount. There are formal ways to price bonds given expected interest rates and the face value of the bond, which is the cash amount that you're going to get when it comes to maturity and whatever interest is built into the contract. It'll observe that price and it'll look at the prices other people are paying to buy and sell these bonds because of what they think is going to happen to the interest rate, or for whatever other reasons there are where people are willing to overpay or underpay relative to the face value and interest rates for bonds. The Fed will start selling bonds when they sell bonds at rates that are below. So the Federal Reserve can't make banks buy or sell bonds, but they set these prices in a way in which the prices at which they offer to buy bonds, or the prices at which they're looking to sell bonds, in ways in which rational actors in bond markets are going to buy as the Fed wants them to, or they're going to sell as the Fed wants them to. And that's all it is. Open market operations is just buying and selling bonds, usually government securities. So how on earth is this a tool of monetary policy? What does buying and selling bonds have to do with anything? Particularly the interest rate. When the Fed buys bonds, you'll often hear that the Fed is going to buy bonds, they're going to buy more bonds or use open market operations to lower the interest rates, or they're going to raise interest rates through open market operations. So what does one thing have to do with another? And then when you think about interest rates, well, hang on a second. There's the interest rate on an auto loan. There are different interest rates for different borrowers. There's an interest rate on a mortgage. There's an interest rate on a credit card, on a student loan, on all sorts of loans in the market. There are all sorts of different interest rates, and all these different interest rates are different rates. They're different numbers. There are riskier loans that have higher rates. There are less risky loans that have lower rates. But there are a whole bunch of different rates. So why is it that if the Fed looks to buy bonds in bond markets, how on earth is that going to cause interest rates to come down? Well, the Federal Reserve isn't necessarily trying to affect interest rates on things like credit cards. It's actually targeting you will often hear when you're listening to economics news that they're targeting the federal funds rate in particular. And remember, that's not the one that they set. The discount rate is the one they set. The federal funds rate is set by individual banks as they borrow and lend from each other. The market reactions in micro, it's the same thing, just in a money market. You have demand for loanable funds and you have supply of loanable funds. So some banks will have demand for a certain amount of money to be lent to them to cover their liquidity needs for the next day. Other banks will have supplies of these loans, and there are different amounts that they will demand and supply at different interest rates. The interactions will have one particular rate emerge. That is the rate that the Fed is looking to target with its bond buying, but it still doesn't seem to be related. But first, let's see how the federal funds rate is related to other rates. Whenever someone is looking to borrow money, they're looking to borrow money from someone who's looking to lend money. And whoever's looking to lend money, they have extra money and they're trying to turn that extra money into more money over time. And to do that, they're lending it out to somebody who's going to make some sort of use of it now and pay it back in installments with interest. And you're more willing to make a risky loan if the interest is high. And while you'd like high interest on a lower risk loan, you also want lower risk, so you'll accept lower interest rates. So whatever market you're lending in, wherever you're putting that money, similar markets with similar risk levels and similar rates are going to impact your decision. Why am I going to lend money to this high risk person if I can get a higher interest rate from this other high risk entity I can lend to? So those are going to be related to each other. And everything is related to the next closest thing, all the way down to the bottom of the barrel in terms of low interest rates, where you have the absolute lowest risk loans, which are loans to the federal government through bonds. And of course, when bonds are bought, they're oftentimes not freshly issued by the federal government. Somebody else had them and they sold them, but you've bought access to that money that the federal government is going to pay out as the various bonds they issued come to maturity. So you now have the right to that money that the federal government is going to pay out when they pay back their loans. You have bought access to it. And that's a very, very low risk place to put your money. But it's something where you're pretty darn sure it's going to come back. And the other low risk one is lending to other banks. You can be pretty darn sure, as I've already mentioned in the previous video, that the banks are going to pay back their loan. So those are about the lowest risk things that a bank can do with its money. Pretty much the next lowest risk thing a bank can do is a mortgage. For a lot of reasons, people are more likely than not to pay back their mortgage, especially people who can easily qualify, people who have high enough incomes, low enough levels of financial obligations so they have enough cash flow to where they have the money and it's not hard to pay back that mortgage. Or if it is, it's still one of the most important bills you have to pay when you buy your home. That's the roof over your head. That's the home you own. You've put work into it. For all sorts of reasons, nobody wants to default on their mortgage. Nobody wants to go through foreclosure. You'll lose your home. That's awful. And of course, it's a loan that has collateral. A lot of loans don't have collateral. An auto loan, for example, there is collateral there, but cars become less valuable over time. So if you repossess a car, you're repossessing something that's worth less money than the loan that was given out to buy that car. With a house, houses can rise in value. Of course, you're not always going to get that in resale value when you foreclose, so banks can lose money on mortgages even if they foreclose on the property and then resell it. However, people aren't going to default on their mortgages if they have any choice. It's rare. It's the exception to the rule. And B, that asset that you can seize if people do will greatly eliminate a lot of your loss. You may still lose money, but it's not going to be as much. So that's a pretty low risk loan too. It's a low risk loan, enough of a low risk loan to where banks prefer to lend in those situations. But of course, you have much less risk when lending to other banks. So you're going to charge a higher interest rate for mortgages because it's higher risk, but it's not going to be that much higher because it's one of your lowest risk options. So interest rates are related to risk. The lower the risk, the lower the interest rate. The higher the risk, the higher the interest rate. And banks are looking for, mortgages are kind of that happy middle where you're getting a higher interest rate than on other low risk loans, but it's still a pretty low risk loan for banks to make, given that they tend to give those loans only to people who are really low risk borrowers, people with good established incomes, who have good savings accounts. They're not having to spend a lot of money to pay back other debts, etc. So if the federal funds rate goes up, it becomes a little bit more attractive for banks to lend to other banks. And rates on bonds are also going to go up, so it's a little more attractive for banks to buy bonds. These are lower risk, but the rates are a little higher. So in order to give out a mortgage, they're going to end up wanting an even higher interest rate on that mortgage. Meanwhile, if interest rates are really low, if you're buying bonds or lending to other banks and when you get it paid back, you're making essentially nothing, you would much rather give out a mortgage. So interest rates on those are going to naturally fall. The other thing that's happening here, though, is when the Fed is buying bonds from banks, what's happening is you go to the balance sheet, and let's in fact do that. Remember this thing. Let's say that we have a bank with $100,000 in it, and it's got let's say 70,000 in loans and 20,000 in securities and 10,000 in reserve. So its net worth is 0. It's perfectly let's say that the reserve requirement is 10%. So there are no excess reserves. And this bank is apparently happy. This is where it wanted to be. But now let's say that the Federal Reserve decided to buy some of these bonds. So what happens here, let's say that the bank goes ahead and sells off $10,000 worth of their bonds. And so this number goes up to, let's say, 21,000. Because again, they sold $10,000 worth of bonds, but the Fed overpaid. And this is a big overpayment here. The Fed is really trying to inject cash into the banks. So when this happens, the deposit amount hasn't changed, but they now have more in reserve. They converted their bonds into cash. Look what happened to their excess reserves. It went from 0 all the way to 11,000. So they've got some money that they're sitting on that isn't earning them interest. This was earning them interest, but they cashed those in for a profit and made more money there. They're going to want to lend that money out, ceteris paribus, of course. So this is why buying bonds is expansionary. It will expand the money supply. Remember the money multiplier here, which is 10. That 11,000 is going to get lent out. Other banks are going to get more deposits, more excess reserves, make more loans, etc. Money supply is going to grow, and thus so will the economy, is the expectation anyway. And of course, if you do that in reverse, let's put this back at 20,000 and put this back at 10,000. Let's say now that the Fed decided, actually let's go ahead and change this number a bit. So now we got to change a few of these other numbers now. Some excess reserves. Yeah, the required reserves are now 1,500. Oh, but we have to add, to balance that out. Oh, that adds up to about 150,000. So now they have these excess. That's what I wanted. I wanted there to be excess reserves. So the Fed is now selling bonds at really good rates. So instead of lending this money out in riskier loans, banks are now finding that they can get some securities that are worth a lot more than the face value that they're buying them for. They're getting really good deals. So let's say they buy 20,000 worth, and this now drops to 40,000. They still have some excess reserves. They're above their required reserve amount, but they now have less in excess reserves. They have less in reserve, more in securities, less is going to get lent out. So let's say that banks now make this, they buy a few more of these, they sell a few more of these bonds, and that results in another, I didn't pay attention to how much was sold. Let's say that really good deals here, that drops the excess reserve amount down even more. So banks are less likely to lend money, more likely to want to sell there. And so the money supply isn't necessarily going to go down, but it's going to stop growing by as much. So you can play around with this, change the numbers, and see how the excess reserve amount is going to change, which will grow or contract the money supply accordingly. And that's how bond buying works, to not only increase or decrease the money supply, but increase or decrease the interest rate.